Welcome to This Explainer. Today, we are cutting right through the noise to analyze the recent, honestly kind of crazy, volatility surrounding semiconductor giant Broadcom. It's one of the most talked about companies in the market right now, and for good reason. Just a few months ago, this tech powerhouse was riding the artificial intelligence wave perfectly. But recently, well, the stock has taken a bit of a haircut, and we really need to figure out exactly why. Okay, let's dive straight into this absolutely terrifying number. $370 billion. Yeah, you heard that right. This is the massive figure that recently generated screaming headlines and genuinely spooked the market. But we have to ask, is Broadcom actually in massive trouble, or is this just noise obscuring a brilliant buying opportunity? To separate the facts from the fear, this explainer is going to walk through four quick things. First, the current controversy. Then we'll weigh the bull case, the bear case, and finally wrap up with an actionable investor framework for your portfolio. Let's get right to it. All right, part one, the controversy and debunking the debt myth. First up, we need to address the elephant in the room and dissect those scary headlines you've likely seen regarding massive debt and fierce competition. So, a recent Bank of America report estimated that Broadcom's AI financing platform could involve up to $370 billion in senior debt by mid-2029. That sounds incredibly alarming at first glance, right? But here is the absolutely crucial reality check. That $370 billion, it's a financing projection for their customers, not debt sitting on Broadcom's actual balance sheet. It's really just an estimate for a platform built with partners like Apollo and Blackstone to help customers lease massive AI infrastructure. And while yes, Broadcom does guarantee some of these leases, their actual company filings cap their maximum guaranteed loss on the first major deal at just $29 billion. Even in an absolute worst-case, doomsday scenario across the board, Bank of America models the maximum potential loss at around $42 billion. Now, don't get me wrong, $42 billion is a massive figure, but it is a far cry from a company-ending catastrophe, and it is absolutely categorically not $370 billion in direct, on-the-books debt weighing the company down. Then the other massive headline hit when Marvell Technologies secured a custom chip deal with Google. Now, Google is a key customer for Broadcom's tensor processing units, or TPUs, so this development, it's a legitimate headwind. Because Broadcom relies so heavily on those massive cloud providers, the hyperscalers, any diversification of their suppliers creates a real stir in the market. But the story behind their market position is actually way more nuanced than just one single lost contract. Which brings us to Section 2, the bull case. Let's shift gears here and look at the engine driving the overwhelming optimism behind AVGO and explore exactly why Wall Street remains so heavily invested. Get this, despite the recent noise and all those scary headlines, over 90% of analysts still rate this stock a buy or a strong buy. In fact, major institutions like Bank of America, Goldman Sachs, and Jefferies are setting price targets that imply a 30% to 40% upside from current levels. So what exactly do these financial heavyweights see that the panic sellers might be missing? Well, the answer lies in explosive growth. This is the absolute engine driving the entire bullish thesis. Broadcom's AI semiconductor revenue surged a staggering 143% year over year, hitting $10.8 billion in its latest quarter alone. This kind of rapid, undeniable revenue expansion in a hyper-competitive AI sector is exactly the type of performance that major investors are hunting for. Adding serious fuel to that fire, management provided a stunningly clear and honestly aggressive target. They stated they have a line of sight to over $100 billion in annual AI chip revenue by fiscal 2027. To put that monumental figure into perspective for a second, hitting that target would nearly double their total overall company revenue from just a single year ago. That's huge. Goldman Sachs recently argued that the market is just being way overly pessimistic about competitive threats here. Broadcom's advantage isn't just clever chip design. It's this incredibly strong, three-pillared moat that protects its market share. First, manufacturing scale. They have the unique capacity to ramp up production way faster than smaller rivals. Second, proven execution, boasting a decade-long track record of delivering highly complex custom chips on time. And third, deep customer relationships. Once a hyperscaler spends years co-designing a specialized chip with Broadcom, the financial cost and operational risk of switching to a new supplier are absolutely enormous. Plus, there's a massive networking bonus. Broadcom also provides essential networking silicon. We're talking about critical pieces of hardware, like the highly advanced Tomahawk Ethernet switch, that physically connect tens of thousands of processors within these giant AI data centers. What this means is that even if Broadcom happens to lose a tiny slice of the specialized compute market, they still benefit massively from the overall structural expansion of AI infrastructure globally. They're basically selling the picks and shovels for the AI gold rush.
All right, time for Section 3, the bear case. To remain completely objective in this explainer, we have to ground our analysis and look at the very real risks that you simply cannot ignore.
The first major risk is customer concentration. Broadcom's custom accelerator business relies heavily on a really small group of massive buyers. We're talking maybe 4 to 6 mega customers in total. If just one of those tech giants decides to pause orders or shift a major contract to a competitor like Marvell, MediaTek, or AMD, it causes significant near-term volatility. And actually, that is exactly the dynamic we saw play out in June.
And that concentration risk bleeds directly into valuation. While a forward price-to-earnings ratio of 24 suggests the market expects future earnings to catch up nicely, Broadcom is currently carrying a high trailing price-to-earnings ratio of 63. That high trailing number, which measures price against past earnings, shows this growth stock is currently priced for absolute perfection. And in a high interest rate environment, premium valuations get punished severely at the very first sign of a slowdown.
There's also immense execution risk here. Hitting $100 billion in AI revenue by 2027 requires rapid, essentially flawless expansion. But that ambitious target could easily unravel in a three-step cascade. First, overall AI infrastructure spending could slow down across the broader market. Second, Broadcom could face unforeseen production bottlenecks. And third, if that massive revenue target slips as a result, the market reaction would likely be swift and totally unforgiving.
We also must remember that tail risk from the financing guarantees we discussed earlier. Yes, it's not direct debt on the balance sheet, but if a severe economic downturn triggers multiple customer lease defaults on that new financing platform, Broadcom could still be on the hook for billions in losses. It is an edge case, absolutely, but it's a real macroeconomic risk you have to factor in.
Finally, Section 4, Actionable Investor Framework. So the crucial point is, what should you actually take away from all this data, and how does it apply to a personal investment strategy?
How should you position yourself? Well, based on the analyst frameworks, it depends heavily on your investor type. For long-term growth investors who believe in the 5 to 10-year AI build-out, this is viewed as one of the best plays available. You just have to stomach and hold through the volatility. Now, if you're a value or income investor, the yield is below 2% and the valuation is quite rich, meaning you should probably look elsewhere. And finally, for traders, the consensus is to expect sharp volatility on news and definitely keep your eyes peeled for the September 2026 earnings report as the next major market catalyst.
Market bulls ultimately argue that the current competitive fears are a bit overblown in the short term, citing Broadcom's deeply entrenched relationships and massive manufacturing scale as an ultimate buffer. Based on the analyst reports, safely navigating this high-conviction growth story comes down to 3 strategic steps: using dollar-cost averaging to mitigate timing risk, watching major customer news closely as a leading indicator of revenue shifts, and utilizing market pullbacks as entry points if you have a long-term horizon.
Broadcom is undoubtedly a high-conviction growth story trading at a premium price. It absolutely requires a stomach for volatility and a multi-year outlook. We've separated the facts from the fear and laid out the entire picture objectively for you today. So my final question to you is this. Based on the hard data we've unpacked, where do you stand? Are you bullish or bearish on Broadcom? Let that sit with you as you review your portfolio. Thanks for joining me on this explainer. Keep learning, and I'll see you next time.